Good morning and welcome to the Killik and Co market update. UK government bond markets have calmed down this week following the turmoil that we had last week after the disastrous mini-budget. As we talked about in last week's video, the Bank of England really helped to calm the markets down when they stepped in and agreed to buy government bonds. And to add to that, the government has done a U-turn on its very unpopular policy to abolish the additional rate of income tax. Although volatility in the markets has certainly calmed down, bond prices are still at much lower levels, and that means that bond yields are much higher. Here's a chart showing the yield on the 10-year government bond, and you can see that it's now above 4%. And this is bad news for the government because it means they'll now have to pay more if they want to borrow in the future. It's also bad news for the housing market because mortgage rates tend to be based on the 10-year gilt yield. This week, the average two-year mortgage rate went above 6% for the first time since 2008. This chart here shows the breakdown of different types of housing tenure, and you can see we've highlighted the UK with that pink dashed box there. If you look at the blue bar, you can see the percentage of people in the UK who own their house outright with no mortgage, and those people should be protected from this increase in mortgage rates. The light blue then shows people who own their home but they have a mortgage, so those people stand to lose out because of higher mortgage rates. The royal blue then shows people who are renting, and it's possible that rents could go up because landlords may be forced to pass on the higher costs of their own mortgages. Generally speaking, it's likely that when interest rates go up, housing prices tend to weaken. Here in the UK, we certainly do have a shortage of housing supply, and that should provide some support to the housing market overall. But historically, when interest rates have gone up, it has tended to be relatively bad news for house prices and therefore for house building stocks. And also this week, OPEC Plus has announced it will cut oil production in order to prop up the oil price. OPEC, which stands for Oil and Petroleum Exporting Countries, is a cartel featuring some of the world's biggest oil exporters. The largest members are Saudi Arabia, UAE and Iraq. The OPEC countries account for about 40% of global oil production, and they work together to control output and therefore to influence the price of oil. OPEC Plus includes other non-OPEC countries, particularly Russia. The cartel has this week announced that it will cut production by 2 million barrels per day, which accounts for about 2% of global output. Here's a chart showing the price of Brent crude over the last 10 years, and you can see the drop over the last few months based on fears of a global economic slowdown, and you can also see that little spike that's happened this week when this production cut was announced by OPEC. Although OPEC's decision will certainly have an impact on the price of oil, the cartel's global market share has declined quite heavily over the last few decades, and it doesn't therefore have the influence that it used to have. And that's mainly because production in the US has increased hugely over the last few decades. This week, the US has been very critical of OPEC for siding with Russia, and this is likely to make countries in the West even more determined to be more independent in terms of where they get their energy from. And finally this week, I just wanted to mention SSE. Labour Party leader Keir Starmer has caused a bit of concern in recent weeks by talking about a nationalised energy company. This has reminded many investors of the days when Jeremy Corbyn was running the Labour Party, and he had announced plans to nationalise all British energy companies at prices that would have been very negative for existing shareholders. We can have a look here at the share price chart for SSE over the last 10 years, and you can see a lot of weakness between 2016 and 2018 when Corbyn was pushing those plans very hard. However, this week, Keir Starmer has clarified his own intentions, and he's made it very clear that actually he does not intend to nationalise any existing energy companies. Instead, he would like to set up a new government-owned energy company. At the moment, there are no clear published plans about this, and also it would require the Labour Party to be in power in the first place. But for the time being, it's certainly good news for SSE shareholders that the party would not intend to nationalise the company. Moving on to have a look at next week, we're moving into the next earnings season, so things are starting to get busier. Next week, we're expecting results out from LVMH, JP Morgan and United Health. That's it from us. Enjoy the weekend, and we'll see you next Friday.